Oil prices rose to almost $95 a barrel overnight, and Australia's economy is showing early signs of perking up ahead of minutes today from the RBA. That's coming up in our 5 things in 5 minutes. And then in our bonus deep dive interview, Daniel Hynes looks at the IEA's prediction that oil demand will be falling by 2030.
That allure of peak oil demand is probably something which gets pushed further and further out as we talk about it more often. And I suspect it'll be within our lifetimes.
But first, in 5 and 5 with ANZ, Brent oil prices rose again overnight to almost $95 a barrel on concerns that Saudi Arabia and Russia will restrict their supply, and hopes that demand from China might be stronger. Prices have risen more than $20 a barrel since June. That's when the Saudis and the Russians surprised markets by extending their production cuts through to the end of 2024. And that was despite a rally over $90 a barrel. ANZ senior commodities strategist Daniel Hynes has mapped out the global supply-demand imbalance for the December and March quarters.
We see a pretty sizable deficit forming in the order of over 2 million barrels a day, which is up there with some of the largest deficits we've seen in the market in recent times. Saudi Arabia is likely to maintain this bias towards a tight market until, I suppose, the uncertainties around the global economy and demand, in particular in countries like China, become a little bit clearer.
Number 2, Australia's economy is showing some early signs of a few green shoots poking through. ANZ's Head of Australian Economics, Adam Boyton, points to forward orders in business surveys lifting since May, higher job ads in the last couple of months, and a stabilisation of consumer expectations about unemployment.
Now, it's not that any one of these indicators is going to be perfect, but what we find when we put them together is they tend to give us a bit of a steer on turning points or inflection points. They're still telling me the unemployment rate will drift higher over the next year or so, but only ever so slightly. And they're just starting to improve. So look, don't want to get too excited about that yet, but I do think maybe it's telling us that some of the more downbeat views on the Australian economy, perhaps a little more upbeat or a little more positive than that.
Number 3, Adam will also be watching the minutes from this month's RBA meeting. They're due out later today, and he's curious about whether the RBA considered a hike this month, as they did last month and the month before that.
It'll be interesting to see, I think, actually, how much discussion was there around putting interest rates up in September. We suspect not a lot, and that would fit with, I guess, the bank having become increasingly comfortable with the current cash rate setting and that the economy appears on track for a soft landing with moderating inflation.
Number 4, Adam will also take a closer look at the RBA's comments on just how sticky Australia's services inflation is and how much of an easing there is going on in the labour market.
It'll be interesting to see if there was any discussion about the stickiness of non-tradables or services inflation. We thought that the post-meeting statement might have alluded to that a little more. In the end, it didn't. So I'll be looking to see if there's any residual concern at the bank about the stickiness of services inflation.
Number 5. China's yuan, or the CNH, is well supported at the moment by the People's Bank of China, the PBOC. Signs of a warming economy in China on Friday are also helping. Here's ANZ's Head of FX Research, Marja bin Zaman.
PBOC, they do have the experience to manage severe currency weakness, having done so following the 2015 devaluation and when the yuan weakened during the Trump trade wars. So there are many other measures they can continue to use in the event that the yuan weakens further. The measures that PBOC has been using will continue to be supportive in preventing it from touching new lows.
Marja bin Zaman there. And now it's time for the bonus deep dive interview. My colleague Catherine Dyer asked Daniel Hynes about the International Energy Agency's view last week that demand for fossil fuels will go into permanent decline before 2030.
Yeah, look, we're probably not in that camp just yet, although I think peak oil demand won't occur too far past that point. Certainly we're seeing the initial impacts of the energy transition occur, particularly in China. The the largest EV market in the world, is certainly starting to crimp growth in gasoline demand. I suppose the real issue will be around oil's use in the broader economy, and it goes a little bit unnoticed, I suppose, the use outside of its main transportation in plastics in particular. And so those things are still going to persist. And so I think, that allure of peak oil demand is probably something which gets pushed further and further out as we talk about it more often. And I suspect it'll be within, our lifetimes.
So historically, new energy sources have always stacked on top of earlier ones, with any efficiency gains translating into demand growth. So what is the critical mechanism here that would change that story?
Well, I suppose this is a unique situation in the world of energy. We've got a energy transition which is being basically managed, by governments in the goal of reducing emissions. It's government policy which is really driving that, and raising the cost of using those fuels is the main tool that they're doing that. So energy efficiency gains ultimately reduce the cost of producing a product such as oil or coal, but that will then be slapped with that cost of carbon, which we're seeing through the use of carbon markets globally at the moment. And I think that will potentially reduce its demand, despite, I suppose, those efficiency gains, which can sometimes increase demand, as you highlighted. But, there's a lot of water to flow under the bridge, a lot of technology change going on. Maybe those efficiency gains result in that peak demand point coming later than we expected. But as I said, I do feel like, those policy measures will ultimately reduce demand.
Do you think we're likely to see stranded assets in oil and gas, or is the timeline kind of predictive enough to be able to manage that?
No, I think that's a real risk. And certainly it's a concern that a lot of oil and gas producers that we talk to, are thinking about right now. I mean, when you're looking at a major oil and gas project, you need to know essentially if the buyer is going to be there in 20 or 30 years' time, the lifetime of that project. And if there's any uncertainty about whether demand will be there, then there's going to be a reluctance to invest the billions and billions of dollars that is required to bring these assets online. So yeah, it is certainly an issue which is just on the precipice of being a major hurdle. It won't be too long before it really starts to have an impact. And that's, I suppose, when that energy transition will go through a very messy period. It's going to create a lot of dislocations within the market. So that's something I suppose we have to be prepared for.
Daniel Hynes there talking with Catherine Dyer. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, September the 19th. Catch you tomorrow with all the detail from the RBA's minutes and previews of rates decisions by the Fed and central banks in the Philippines and Indonesia. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.